Cash flow analysis is one skill you're going to have to master if you were to analyze businesses for sale. In fact, it's a very critical skill, the one that I go over my one-on-one clients over and over again. One of my clients actually last week sent me 3 deals to analyze. So with his permission, I thought it would be a good idea if you were to look over my shoulder as I am analyzing deals on a cash flow basis in real time. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by purchasing another business, or if you are a W-2 employee sick and tired of being in the rat race and wanted to buy a profitable business, then you come to the right place. And I'm going to encourage you to subscribe to my channel. Don't forget to hit the bell. And you'll be notified every Thursday when a new video comes out.
Okay, everybody, here we go. Deal number 1. We're going to be looking at a profitable, urgent, well, that's what the listing says, profitable, urgent care center for sale. As we discussed at the beginning, I'm going to go into what the kind of analysis that I do, very cursory analysis. We're not going over any particular information given to us by the seller other than what's in the listing. What was shared with me was the listing itself and one of those for sites sales. And that doesn't mean that there are no good deals out there in the different websites, but not all of them are good. So I'm going to show you what I like and don't like about each of these 3 deals we're going to analyze today, and hopefully this is helpful. So number 1, urgent care center for sale. So what I've done here, this section in blue, this is information that is readily available here in the listing. This section in green is what I would offer. And this is just some debt service calculations that I'm going to explain in a little bit, okay? So let's talk about, this is what we have here. So this is the listing price. They're asking for $590,000. So I'm going to actually make this, I like the green. Okay, so $590,000. That number goes here. This is a $590,000 asking price or the purchase price. Gross revenue is $500,000. It's actually here. $500,000 in revenue. This is on an annualized basis. They're telling me that this urgent center is generating $500,000 or about $42,000 a month. Okay, cash flow, very, very important. Cash flow to me is everything. So the cash flow they're telling me is $190,000. I just plugged it in right here. So there's a formula here that calculates the purchase price or the asking price into the cash flow. This is very important that you know, because it is based on cash flow that we're going to calculate the debt service coverage ratio. And as I've said in other videos, and particularly if you want to get this approved and funded as a purchase by the SBA is a cash flow lender. So different than a traditional non-SBA lender, they're going to be looking at the cash flow very, very closely because they're going to lend you on the cash flow, and they are going to be able to spread that amortization longer because of the cash flow, unlike a traditional lender that is going to be looking at more assets to collateralize in the business. And you know that you may know that from any service business will have very little in terms of assets, only the AR, very few things, furnishes and fixtures and equipment is going to be very little, although in here it says it's $310,000. I'm not even going to worry about that because I want to make sure that the deal can cash flow post debt service. So back to this, $190,000. It gives me a multiple of seller discretionary earnings of 3.1. Is it good? Is it bad? We're going to find out in a little bit. EBITDA is $240,000. So this transaction is this business is being sold at a little shy of 2.5 times EBITDA. Now, there is multiple ways that sellers will calculate their, EBITDA in the cash flow. And obviously, as you see here, we would need to test the net income assumptions during due diligence because I really never believe what the seller is saying. I want to see what they actually show the IRS through ordering transcripts of their tax returns, because you want to be looking at that stuff that is actually in the hands of the IRS and compare that to what the seller is telling you in their interim financials, unless the financials are audited or compiled. Actually, I would prefer audited. So anyway, back to this. So here's the financing piece. So as we're looking through this, they're saying here somewhere here, I'll go back to this in a bit, that they want the financing piece. They are saying that they would like you to put 80% down or $472,000 down, or 80% loan to value of the purchase price. And the seller will be willing to finance a 3-year note equals to 20% or 118,000. Hey, sounds pretty good for the seller, right? They're going to get 80% cash up front. They're saying that the APR about 7%. So I have calculated numbers. The debt service, principal, and interest over a 3-year repayment period would be about $43,772 per year, which gives us an annual cash flow post debt of what? $146,000. Your cash on cash return is not bad at 31%. You know, the more cash you tie on to any deal, the lower your cash on cash return. You're going to notice that the lower the cash, the higher the cash on cash returns, because you're using leverage. Your leverage is the debt. So as things stand right now, your cap rate is 32%. I mean, these are some pretty awesome cap rates. Even if I don't like the numbers too much, as you'll see later, it's not bad that a cap rate 32 times, 32, you know, would be lucky to get 8% cap rate on a commercial building. You know, this is an entirely different ballgame. So, all right. So now let's talk about the deal itself. So everything in red, I don't like. Everything in black is just, you know, information to me. So when I'm looking at a deal, any business for sale, I look at how long they've been in business. I will discount heavily a business that is very, you know, young or close to a startup. To me, any business that is 2 years or less is a startup. A 3-year-old business is pretty close to being a startup, just basically just over the break-even point. You know, basically the first 2 years are just a starting point. So blah, 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 level 3 urgent care facility, great, and they're going to throw everything that they can to sell you on it. Why buy? It has shown consistent and exponential growth over 3 years. Well, we're going to see what they're talking about. What growth has it shown from January through December? Incomes 116, expenses a negative. So it was a huge loss in, you know, year one, which I understand. You know, very rarely you're going to have break even on year one. Well, let's see what happened in year two. Year two was revenue of 211, expenses of 301, and negative income of 90K. So we have 2 years in the red. Wait, there's another year in the red. From January to December 2020, income was 340. I mean, revenue. I mean, income it could also be revenue. I don't, you know, there's a lot of those names will be used interchangeably. To me, it's revenue, which could be net revenue. In this case, they're calling it income, which minus expenses is going to be net income. So break even happened in year three. Now, I don't like this. I don't like this for the price. Now, everything has a price, but I don't like the price. Based on this, I don't like the price they're selling it for. First profitable year is last year. Now, keep in mind that 2020 was a COVID year, which means a lot of businesses went down. In 2021 are usually normalized over a longer period of time. So if I'm analyzing this deal, I would take to see what we did prior to COVID, so 18, 19, and what we did after COVID in 2022 year to date would be a key factor when they're trying to normalize the revenue, expenses, and net income in order to get a loan approved. And this is a good thing that the lender is analyzing all this as well, because we want to make sure that if you're going to get into a deal, that it be sustainable profits, sustainable revenue, and sustainable net profits. Now, they put it here in why buy now, because this is broken even and is now profitable. Okay, good. I mean, it should be breaking even. Am I going to be rewarded for them being profitable? You know, I shouldn't have to pay any more for a business that just became profitable. So, okay, that's a discount to me. So what you're seeing in red, I don't like newy business with a lot of losses in the first couple of years. Is there room for growth? Okay, this is what they say. Sure. If you are an owner, if you're an operator that has a lot of experience in this, which is something that you should really consider as you're getting into any business, the less you know about the industry, the more of a disadvantage you have. The more you know about an industry, the more you're going to be able to spot trends. So I would advise any client, although you don't have to be a subject matter expert in the industry that you're buying into, you have to have enough collateral knowledge to help you. Either somebody is going to be there as an operator to run your business because you're the investor, you're the actually one buying the business. So you're not caught by surprise on any metrics that may be off. So they're asking 590, as I said. Why buy and establish? They're saying that you'll be avoiding a build-out cost of $160,000. Okay, I get that. I really don't like startups. Startups have a high failure rate. I've been involved in startups multiple times. I've been involved in businesses that are more seasoned. I rather buy an income stream than actually gamble on a startup. That's just where I stand. The asset fair market value, it's 150. I don't know how much of that, but they're saying that the AR is 200,000, but the fair market value is 150. I mean, that doesn't make sense. Access to our patient base is valued at 100,000. Well, that beauty is in the eyes of the beholder. Why would it be worth 100,000 to me? I'm actually buying the cash flow stream. So if it goes with it that I should expect that the clients be loyal to us and being able to continue to generate more revenue. So let's keep going down here. This is the asking price. There is a lease. So when you're buying a business, you want to be very, very cognizant of when the lease is up. So it looks like, we're in 2022 right now, in July 2022. So you got about little less than 2 years, but 21 months left on what it could be a 5-year lease. So you really can move. So the facilities are built out, competition, etc. So I don't like the financing that they're proposing. Now, the reason for selling, this is telling the billing was poor and loss of money was significant. Owner found or basically funded its high account. So that's a red flag. Okay, so this is a no-go for me. But if you're really interested, just because you are a turnaround expert, you understand this industry and you want to buy this, I would propose a much more manageable asking price. So now this is something that I've known that in urgent care center or UCS that is less than $1 million in annual revenue, which is what we're looking at here, should be trading at 3.5 to 4 times EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Now, the assumption at $1 million in revenue is this does not differentiate whether the business has been around for 20 years or 2 years. So if you're going to be on the higher end of the EBITDA, you have to be a seasoned, profitable business with a long history of revenue, growing revenue and growing net profit, because that's the only way that the lender or you're going to get any assurances that the business will continue to be a going concern long before the seller retires or sells it to you. So if they're saying that it should be up to 4, given what I told you, I don't like the fact this is a 3-year-old business. I probably would not offer any more than 2 times cash flow. So my offer, as you can see here, we'll take the cash flow times 2. That gives us a purchase price of $380. So, you can see here, okay, well, what's the difference in price? It's a $210,000 discount, okay? That would be a discount that I would want just because of the risk that I'm taking. So keep that in mind as we're doing this right now. Cash flow remains the same. Of course, it would have to be completely scrutinized during due diligence. What I love about the SBA is that you can very little equity, 10% equity, or basically 10% down payment from the buyer. So that would put you at 38,000 on a purchase price of 380. 342 would be a 90% SBA loan at prime plus 2.75 max. Now, are some SBA lenders are going to be doing less than than the 2.75 cap? Yeah, maybe. But I am assuming this is going to be a max 2.75 on prime rate. Prime rate right now is 4.75. So you do the math. That's 7.5% APR interest rate. APR may be a little higher, but let's see how the numbers shake up. Debt service on a $342,000 loan amortized over 10 years at 7.5%. It's $48,715. Now, look at the annual cash flow after debt. Pretty eye-opening, right? Because you make money when you buy, not when you sell. So we're taking our cash flow minus our debt service. It gives you $141,000, almost $12,000 a month in net cash flow, free cash flow, that is. Now, look at the difference between these two. So if you were to put out of your own hard-earned money, say you were to take money out of your 401k or individual retirement account, and you were to cough up a $472,000 down payment and have the seller carry a 3-year note, you're going to end up with the same cash flow that you end up with your actually buyer, right? Put 10% down and finance 90. Let this be a lesson to you. Look at the cash on cash return, 372%. Look at the cap rate, 50. It's just crazy. 50 times the net income. So, okay. So this is pretty awesome. So obviously, questions for the seller. Why are you selling? There are other questions for the seller, but it gives you an idea that, so if you were to see the value on this, whether it is the location or whether it has some synchronicities with another business you already own, whether you are somebody who has expertise and know how to operate these types of businesses, I wouldn't probably go any more than the 2 times cash flow to have some wiggle room, because you would need a debt service coverage ratio of, actually, I forgot to say. So in this particular case, a 3.9 debt service coverage ratio. This is pretty amazing, given the fact that you only need 1.25 over 1. So basically what this is saying, that you have almost $4 for every dollar of debt service. Now, could you possibly get a shorter amortization? Maybe you can even get a 5 years. And what would that look like? Let's just say 5 years. Let's just double that. Say this was supposed to be, instead of 48, should be 96. That's just for kicks. You still have $94,000 post debt service. You still have a cash on cash return of 247%. Isn't that amazing? So under this circumstances, I would say it may just make sense if you know what you're doing. Hopefully this helped you guys. We're going to move on to the next deal now.
Hey, if this video is resonating with you, please like and comment on this video. Your interaction with my videos helps the algorithm look for more business owners and entrepreneurs just like yourself, so you can help me grow my channel just by interacting with me. So I thank you in advance.
All right, we're going to get into deal number 2. Now we're looking at a UPS store for sale. $166,000 in net income. This is per year, and $541,000 in sales. So I have already taken the liberty. This may go a little quicker because you kind of understand what goes in every bucket. So I have a side by side. This is the listing to the left here, and these are my numbers to the right. So let's get to it. So you have, just don't like this color. Sorry. All right, 549,000 goes here. UPS stores. I just want to know when I'm doing an analysis, I just like to know what I'm looking at. I name everything accordingly. So in case I had to go back to it, Just, just kind of how I am. All right, revenue. 541 is right here. So we're taking this revenue, make it a little bigger. Okay, there's our revenue. 541 goes here. 549. So it looks like at the outset that this is more, looks like a one-time revenue deal. I put gross revenue because this is basically the top line revenue. Okay, so cash flow is 166, goes here. So because I already have these formulas, tells me that this is a 3.31 multiple of seller discretionary earnings. The EBITDA is the same as the cash flow. I'm not gonna get into too much detail here, other than to say that sellers sometimes calculate things a little different. You're not always going to have cash flow matching EBITDA, or sometimes cash flow won't be there and just EBITDA. Regardless, we're just going to be analyzing based on cash flow. So cash flow is here. Is that those two numbers are the same? The listing is silent on the amount of down payment that you're going to put down, but let's read on. This is a UPS store, blah, 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 in an affluent neighborhood somewhere in the Southeast. Average household is 141,000. That's a pretty good deal. I mean, if your average household income is 141,000, it must be a pretty upscale neighborhood. And would a UPS store thrive in an upscale neighborhood? You bet. So a recognized brand. This is I've known operators that have done exceedingly well with. I mean, I'm biased. I have a bias for UPS stores. The owner is retiring, so it kind of hits all the. Doesn't say how long they own it, but I would imagine that if they're retiring, maybe they own it for at least 5 years. That should be reflected on the tax returns. Sounds like a loan. This is the right reason to sell. You're not selling because you're ill or went through a divorce. You're selling because you're tired. You want to don't work anymore, and you build this passive income asset. Maybe this is an absentee owner. I don't know, but the numbers kind of make sense to me. Okay, so let's keep going. So what I've done here is traditional commercial lending will dictate at about 20 to 25% down payment, which I put here as 137,000, and the difference, the 75% LTV would be seller. In this case, seller financing, but it could be, might as well be, it could be, a loan. So this is actually here. So this is all interchangeable. 750. It's just a matter of where it goes. So, all right. So 4011, add the two, is the same so far. 75.25, we're looking good. Debt service, I just went, 7% APR, or even if it is 6.5%, you're not going to get more amortization with a traditional lender than 5 years on a deal that is, 549, just because they want to recoup their cash right away. Debt service ratio, coverage ratio, as it stands right now, is 1.70, is decent. You're paying $97,659 per year, which is paid out of cash flow. But if this is a traditional lender, they want to collateralize some of the assets. I don't know what assets this business have. I haven't seen the balance sheet. I'm just going by what they're telling me. Not bad, right? Annual cash flow post debt or after debt is 68,000. The cash on cash return is 49.8. Cap rate is 30%. Okay, so what do I know about this industry? I know that there are multiple ways to value a business like this. You can value it 35 to 40% revenue, annualized revenue plus inventory, or 2 to 3 times EBITDA, net income plus depreciation. Earnings before interest, tax, depreciation, and amortization. So it's a little backwards how they put it. Plus owner's comp, or 76% of annual revenue. So there's either you'll be in revenue plus inventory, or it'll be straight, revenue. But I already told you that a 541 is almost like a one time. So, Okay, so you're looking at 76, 75%. So they want a little more, okay? So they want a little more than 75%. They want almost 100% of revenue, one times revenue. I don't really like to go, especially if I'm going to get an SBA loan. My valuation is always going to be cash flow, because it's out of cash flow that we get debt service coverage ratio. So I'm going to say, for conversation's sake, that we want to come in at 2.5. If we come in at 2.5 times cash flow, then I will give our purchase price based on cash flow, $415,000. Cash flow remains the same, automatically populates this. So your down payment will go from $137,000 to $41,000. So you get to keep more cash in your bank account that you can use for working capital. You don't have to tie it to the deal. But you're financing 90% with an SBA loan. And don't really worry about the rate, because the amortization is going to be your saver. Amortized over 10 years, a $373,500 loan would be $53,000 a year in debt service, or 3.12 debt service coverage ratio. So under this structure, you would have ample cash flow to not have to worry about debt. Even if you have a dip in revenue or anything would happen, this is starting to look better and better. So even if your debt service, you wanted to take this loan, this payment that is amortized over 10 years, and you wanted to accelerate it, you wanted to have it in 5 years, because it's 5 years instead of 10, because the cash flow is so good, that would be 106. So then let's play with this number. At 106, debt service minus your cash flow, it still gives you a solid 157, which means that you have $1.57 for every dollar that you pay out in debt. Totally doable, totally bankable. This is a great deal. Well, I'm going to show you this. So if you were to go with an accelerated 5-year SBA loan because you wanted to make double payments, or just simply wanted to, pay it faster, you still have an annual post-debt cash flow of $60,000 at $106,000, or you'll have $112,000 on a $53,000 debt service coverage. Either way is a great deal. 272% cash on cash return versus 49. You remember what I said earlier, that the more cash you tie in a deal, the lesser your cash on cash return, because what it's at work here, it's leverage. So not only that, you're buying right. You make money on a business when you buy, not when you sell. It's just like real estate. So we're, instead of buying a 549, we can buy a 415. Now, in a particular negotiation, for both parties to win means that one must, both has to lose something. For you to gain something, you have to lose something. You may not end up at a 2.5 times cash flow. You may end up at 2.75. In that case, you will pay, instead of 415, whatever it was, it's going to be 456. It will change the numbers just a little bit, from 415 to 465. It's just a matter of, if I'm advocating for the buyer, I would want you to pay the least. If I'm advocating for the seller, I would want them to get the most. In this case, I'm trying to help you, the buyer. Okay, this is one little tidbit here. This number right here is the delta between the annual cash flow after debt and the new scenario, which is my offer, minus the existing scenario at 75% LTV. That's a substantial difference in cash flow under both scenarios. So this is analysis on deal number 2. All right, deal number 3. I hope this is helpful to you guys. Trying to give you as much good actionable content as I can. So this analyze our last deal for the day. Another UPS store. This client of mine is really interested. I think you're gonna start to see a theme here. 781,000 in sales. That's pretty good. That's better than the last one. 186,000 of owner income. Now, again, different. Depending on who the broker is, they list things differently. This could also be seller discretionary earnings. It could be EBITDA plus owner's comp. We don't know, but we're just going to take this information and put it on the left, and then we're going to analyze. So they're 599 on 781,000 revenue. Okay, remember what I said about the 273%, 76%? This is more in line with that. Okay, so cash flow of 186 or 3.2 multiples of seller discretionary earnings. It's just the same as EBITDA. That's fine. We're gonna take the same, superimpose the same numbers, 25% down. The assumptions are that the seller is gonna want a down payment to make sure that you're real and serious. And the reason for that is because they want more cash up front, but also most lenders are not going to finance anything over 75% loan to value of the deal, loan to asking price. So I already know that. I already said that before. So debt service at 5-year repayment at 6 or 6.5%. I forget what it was. I mean, or even 7, I think it's 106. Debt service coverage ratio 1.74. Solid, not a bad deal. Annual cash flow after debt of 79,000, cash on cash return of 53.31, cap rate. Okay, well, you already know that. I'm not going to repeat it all over again. So I'm going to say this is a 2.5 times deal. This is negotiation, right? So we would offer 465 on the same cash flow. Down payment of 46 instead of 149. Loan of 418 instead of 449. Notice that because we're buying lower, our loans are almost the same, except that I get longer repayment terms. So instead of 106, I'm paying 59. Instead of 1.74, I have a 3.12, which means I have $3 of net income for every dollar of debt service. Our annual cash flow goes from 79 to 126. Our cash on cash return goes from 53 to 272, and our cap rate goes from 31 to 40. Our difference is pretty similar to the prior situation. So notice that you're going to start to see a trend. There are multiple ways to analyze businesses and value companies, but when you're wanting to get the business that you're purchasing be financed by an SBA lender, where you can only put 10% down, then it behooves you to make sure that the numbers make sense on the debt service coverage ratio. So remember the 4 C's that I talk about all the time of underwriting, the commercial underwriting. You got your credit worthiness, comes from you. The capacity to pay, which is your debt service coverage ratio, comes from the business. The collateral may or may not come from the business. And the capital comes from you. So remember that. So I am hoping that this was helpful to you. Please like and comment below. Let me know if there's any other types of deals that you would like to analyze for you. I kind of like doing this. If I have the time, I will prepare this stuff and making sure this is helpful information that you can actually use in a real setting. So thank you so much for letting me share this video with you guys today. I know it was a little long, but hopefully it was helpful. Thanks.
For a limited time, I'm giving away my cash flow calculator, the very thing that we were working on today with all the formulas embedded, so you can actually take any deal from the street and analyze it to make sure it has enough cash flow post-debt service. It is my gift to you. All you have to do is click on the link below and you'll be taken to a page where you can download it. Thank you so much.